Well, it's a lovely afternoon in July in Boston, Massachusetts. I'm sitting here with Wendy McGinnis, and we've been talking about integrated reporting. My name is Bob Eccles. I'm a professor at the Harvard Business School. I've been thinking about corporate reporting, researching corporate reporting, trying to understand how to change corporate reporting for almost 20 years. It's been a long time. It's kind of interesting how I got into this field. I'm not an accountant, I'm actually in organizational behavior. How I got here is less important than where we're at today. The book that I just wrote, One Report, Integrated Reporting for a Sustainable Strategy, came out a couple of months ago in March. It's already been translated into Chinese, and I've met with people in China to talk about it at the Shanghai Stock Exchange. It's being translated into Japanese, into Portuguese, and into Russian. That should be done by the end of the year. I've written two other books on corporate reporting. One was called The Value Reporting Revolution, Moving Beyond the Earnings Game. Another one was called Building Public Trust, The Future of Corporate Reporting. It's probably worth comparing what happened with those two books with what's happening now with my new book. The Value Reporting Revolution book came out right at the peak of the internet boom and right before 9/11. And its basic argument was for greater transparency and for companies to report information that went beyond the required accounting information, key performance indicators that were basically leading indicators of financial results, more information on intangible assets to try and reflect what was producing the market cap that wasn't shown on the balance sheet. The reaction to this book was interesting. There was kind of intellectual acceptance on the part of companies. They said, well, that's right, we would like the stock market to more properly value our shares, and the kind of information you're talking about could contribute to that, but I'm not so sure, and the analysts just pay attention to earnings, and what they meant and they didn't say is we actually are okay with managing, playing the earnings game. The investors thought the idea of other kinds of information was good, but they wanted it on a private basis because they were looking for competitive advantage. So it was a book that got pretty good reviews and didn't change anything. And I was disappointed because I was trying to change things. A few years later, the world changed dramatically again. Internet bubble burst. There was all the accounting scandals, Enron. People were thinking a little bit more about transparency, and we thought, well, maybe we should come out and reissue the value reporting book. It was a little bit ahead of its time, so let's republish it. And I was doing this with some partners at PwC, and the value reporting book was actually interesting. Bob Herz was one of my co-authors, who's now the chairman of the Financial Accounting Standards Board. Mary Keegan, who became the head of the Accounting Standards Board in the UK, and a gentleman named David Phillips, who's a good friend, who's still the lead corporate reporting person at PwC based in London. So we thought about coming out with a revised book, but we decided to write a new book, which I wrote with Sam DiPiazza, who was the global CEO at PwC at the time, who's also a good friend and I spoke to yesterday, who's retired now from PwC, but very busy. This book, Building Public Trust, was essentially an argument for stepping back from just looking at the financial information and financial controls, which was important, and putting it in a broader context. So we proposed a three-tier model of corporate reporting, with the bottom tier being what we call global GAAP. So it was essentially an argument for convergence, which is now happening. Although from the latest release from the ISB, we know it's happening a little bit more slowly than they'd hoped. So the first tier was going to be global GAAP. That would give you accounting information across industries, across countries, that was apples to apples. Tier 2 was industry-specific information on key performance indicators, and it would be done to a set of standards that would be developed by industry groups in various ways. And then Tier 3 would be company-specific information to reflect things that were unique about their strategy. And so the three-tier model was about the content. And we had a chapter on XBRL, Extensible Business Reporting Language, this taxonomy, basically a tagging technology to make the information easy to broadcast and consume. It's like barcodes on data. And the book came out, I got my advance copy, I'll never forget, it came out the day that the WorldCom story broke. And in a sense, that was the straw that broke the camel's back on regulation, because at that time in the United States there was the Sarbanes bill, there was the Oxley bill, And we wrote this book to try and influence the debate and say, don't just go rush to one of these bills, which is exactly what happened in Congress. They came back and President Bush said, I want a bill, and Congress produced the Sarbanes-Oxley Act. And once again, events overwhelmed whatever the message was in the book because everybody was busy writing or implementing Sarbanes-Oxley and dealing with 404. I think that book was published in around 2000, 2001. And, you know, I got busy doing other things at the time. And about a year ago, started thinking about another book on corporate reporting with some significant differences in the point of view that I was bringing to it. The first two books were very much shareholder focused. It was, you know, how do we get information that will help shareholders make better decisions? We recognized non-financial reporting, corporate social responsibility reporting, sustainability reporting, treated that as a really separate exercise. It's a perfectly legitimate thing. This is going to stakeholders. Our focus is on shareholders. I think to some extent reflecting that we were based here in the Anglo-Saxon world, and especially in the United States, much more of a shareholder capitalism model. But a lot of things had changed in the world over that decade. I think a greater recognition by then about the problems around climate change, and that the science became quite clear, and then broader concerns in the world around what both the advantages and the disadvantages were around globalization, and the social dimension being important in all kinds of different ways, whether it's urbanization in developing countries, and equality, and labor and wages, and diversity and gender, a whole set of issues, and always continuing in the background issues around corporate governance and the quality of corporate governance, as well as I think an increasing recognition around resource limitations, which had not been part of the corporate social responsibility movement in the 50s, where people were concerned about externalities, but they didn't have this notion that there was actually limits on the planet. That came later, I think, with Silent Spring and the Club of Rome and so forth.